Hello, everybody. Let's kick this extreme signal trading webinar off. Thank you for taking the time to make it this weekend. We hope you had a profitable week. I'm going to read you a quick risk disclaimer before we proceed with the presentation. The contents of this material are for informational purposes only and do not constitute investment advice. Blue Sky Binary assumes no responsibility for any potential errors, inaccuracies, or omission in this material. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. Binary options trading may not be suitable for all investors as it carries a very high degree of risk to your capital. Trading such products is risky and you may lose all of your investment. Past performance is not indicative of future results. Poor fill rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in binary options, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and binary options trading and seek advice from an independent financial advisor if you have any doubts. So the agenda for today is to give you a quick introduction behind the Xtreme signal, which you are receiving on your binary dashboards. We'll go over the theory behind it. Then we'll discuss calibration of your charts and your binary trading platform. And then we'll go over valid trade setups. Whenever you receive an extreme trade recommendation or signal from the dashboard, what exactly you should be looking out for, and then also the setups to avoid. All right, and this takes typically just a few seconds. And because it's an hourly signal, you actually have the luxury of time on your side to perform that basic visual analysis, which will allow you to filter out the bad or losing extreme trades. Then we'll discuss very briefly the suggested time zones to trade the extreme signals in. And last but not least, money management tips that we will give you. Hopefully that will allow you to navigate the binary option space more profitably when trading the extreme signal. At the very end, I'll take a Q&A if I have missed out anything during the presentation. So to give you a quick intro, the extreme is an end-of-hour signal that fires when the dashboard algo has determined if the price has moved too far and too fast amidst a wider trend, thereby possibly detecting a short-term reversal. And what we classify as short-term in an hourly perspective is basically a reversal for about an hour. Extreme can be used on currency pairs and also some commodities. The signals do not work well during news. Generally speaking, because the extreme signal is a mean reversion signal or a retracement signal, it is effectively looking to call the end of a trend or a brief retracement in a wider frame trend. News normally causes trends. So as a result of that, we would suggest that you don't trade any extreme signals should they fire during news. Last but not least, the strategy is based on 1-hour charts with an end-of-hour expiry. So the theory behind extreme, and this is typically how the extreme formation would look, is essentially the algorithm tries to detect short-term reversals during fast-moving markets, and especially when the algorithm believes that at least briefly or in the short term, the price may be overbought or oversold. Our backtests across 18 currency pairs run over 3 years over thousands of signals show an in-the-money rate or win rate of about 68.5%. Month to date, it's been a tough month for the extreme signal. So if I look at the calculation from the 1st of May to the 15th of May, extreme is at 54.3% with 25 wins and 21 losses. Last week, extreme was at 58%, so a little bit better than the month average. It is worth, of course, noting that the months of January and February and part of March were very good for extreme. So longer term, it is still very much within its strike rate. It's also worth noting that the extreme signals are adjusted, time zone adjusted, and they adapt to market time zones and fluctuations based on historical volatility patterns. Basically, what that means is that the extreme signal may not fire when similar conditions on a pair are met if other conditions are not met. So it's a relatively smart signal. With regards to calibrating your charts, because extreme signals are fired on all FX majors, like Euro US dollar Japanese yen, AUD USD, and cable, and of course some of the more exotic pairs, we suggest that you pull up these charts when you're trading the extreme. Please use a 1 hour chart time frame and switch to candlestick charts. Please apply Bollinger Bands. 14 periods and 2 standard deviations suffice. Some of our senior traders, including myself, use 25 periods just to add us an additional layer of safety. We would not suggest you to trade more than one extreme signal at any given point in time. Sometimes you will get correlated signals firing, and we would suggest for you to pick the one that you believe is best suited for your risk levels and not trade all at the same time. Set your expiry for end of the current hour. So for example, if an extreme signal fires at 11:20 a.m. GMT, you will set the expiry for 12 p.m., right? If it fires at 11:40, you would set the expiry for 12 again. The good news is that most extreme signals fire within the first 3 minutes of every hour. It's very rare for an extreme to fire any point after that. Last but not least, and we'll discuss it a little bit more in the money management section, trade with virtual money for 2 weeks before generating stable percentage return, and then you go live. So within these 2 weeks, you should be able to assess if you're applying all the rules that we're going to be showing you today, and if you're generating above 65% stable return. That means you can actually potentially make this your bread and butter in binary options. Let's discuss some valid trade setups. So what we call here the resistance breach, this here is the best extreme setup. Now these are 2 extremes that had fired consecutively within a time span of about 6 hours. Remember, each extreme is 1 hour long. What the resistance breach effectively, this formation, what this effectively is saying is that when an extreme signal is firing call or put, in this case both extreme signals fired a call and both won, this is best, or this has the highest win rate when the previous candle has actually closed decisively outside a lower or upper Bollinger, okay, or is touching it. This then means that the next signal that's fired is likely to expire in the money. So in this case, you will see that this red candle actually touched the lower Bollinger, or it was almost a fractional touch there. And the extreme fired somewhere in the first few minutes of this candle, and it was a deep in the money rate win. Okay, this was almost 15 pips. And the same holds true for the one that fired a few hours later. Another key bit of analysis that you can run here, and this does help a lot, is not only is the candle touching the Bollingers in both instances when the extreme won, but also notice the shape of the Bollinger channel. It's very obviously flat, right? The lower Bollinger, the moving average, which is the middle Bollinger, and the upper Bollinger, this is a flat channel. And in this case, this normally means that the price tends to be well contained by the Bollinger extremities. What I mean by the Bollinger extremities is this is the upper band, that's the northern extremity, this is the southern band, and this is the southern extremity, and generally price will not be able to breach that unless there is news, in which case you'll get a breakout. Okay, but when you see a flat channel and you see an extreme firing somewhere near or touching or breaking the lower Bollinger and it's a call, that's a high probability setup. All right, so look for resistance breaches. And that, by the way, is the only and the best way to trade extreme, right? Now let's look at the ones which are more dangerous, the ones that we would suggest you to not trade at all or trade at a better price. And I'll discuss that in a second. So the near resistance formation is effectively an extreme signal that's fired call or put when the previous hourly candle closed just below a key Bollinger resistance. All right, and this is likely to expire out of the money depending on what price you got. Okay, so let's examine this signal. Here you have a very large green candle and the extreme fired a put. Okay, and although it fell for the first 15 or 20 minutes, unfortunately, had you received the price at which the extreme fired, which was somewhere around the close of this green candle, you would have expired out of the money by about 5 pips, right? And notice that the previous candle that triggered this extreme, this candle closed well below the middle Bollinger Band, right? This here is the moving average. and it closed about 7 or 8 pips below the moving average. It then went on during the extreme signal, which was fired as a put. It actually went on to climb and it tagged the moving average, as you can see here, and it resisted it. The moving average successfully contained the price, and had you entered a put here instead, you would have actually won the signal. So what we would suggest is when the extreme signal fires and you notice that the previous candle is well below the moving average, just wait until it actually reaches the moving average and then fire a put, right? And the same holds true for a call signal if it's the reverse situation. So if it's a red candle that's touching the moving average or just above the moving average, you just wait till the price drops to the moving average and then you would take a call. The more safer way is if you notice a formation like this, you just simply don't trade the signal. If you're going for very high ITM and very high probability setups, you don't need to chase this trade, you don't even need to wait, you just ignore it. Okay, so this is a near resistance. This is another form of a near resistance extreme. And again, this one expired out of the money. Mind you, the extreme fired here, okay? And it actually continued south, unfortunately, and it was fired as a call. And you would have been deep out of the money had you entered this. And this one is relatively obvious for a variety of reasons. Generally speaking, what you're seeing here is that the extreme, which ended here, and sorry, it fired here as a call, it is far away from the lower Bollinger, right? And it's breached the middle Bollinger. So it's breached a resistance, and it's far away from the lower Bollinger. You're also seeing that the channel, the Bollinger channel, is turning south, right? So here the Bollinger channel was decisively north, the price was rising. However, after this large red candle, you're seeing that the price is actually starting to turn south. And going call here would have actually resulted in a very big loss. So what we would, in terms of pips, so what we would suggest is wait till the price actually touches the lower Bollinger. Then again, you have a resistance there, and then you can expire possibly in the money. In this case, although the chart doesn't show it, the price actually continued south. It turned into a breakout, all right? But this was driven by news, as you can see here, European news. So, and what we said early on in the presentation is avoid trading extreme signals or any type of signals that are mean reversion during news. Generally speaking, you wouldn't have traded this signal anyway because it was fired just ahead of news. But had news not been there, and the Bollinger channel was roughly flattish, you could have actually waited for the price to drop at the lower Bollinger and entered a call, and you would have probably expired in the money. But in this case, the extreme fired here, where my mouse is, as a call, and you would have seen this chart and seen, okay, the Bollinger channel is turning south, and the previous candle closed nowhere near the lower Bollinger, which means it's nowhere near resistance, which means you probably let the signal go, don't trade it, or wait for a better price, all right? Remember, by comparison, this is a valid trade setup. Here, the Bollinger channel is flat, and the red candle has actually resisted the lower Bollinger in both instances. And that's why you would take those signals. In this case here, the candle is closed well above the lower Bollinger, if that makes sense. So you would avoid this. This is another invalid trade setup, and this is known as the early retrace, okay? The early retrace. An extreme signal, call or put. In this case, it was fired a call. It was fired a call actually here, okay, at the close of this candle, and it unfortunately expired just slightly OTM. Notice the second candle is a small doji. Instead of rising up, it actually closed slightly down. And depending on what price you got here, you probably would have lost money on this call. Okay, so an extreme signal that's fired call or put when the previous hourly candle closes as a retracement candle or an engulfing candle. Remember, an engulfing from Japanese candlestick theory, all it basically means is that this candle here is of a different color to this candle. In this case, this was a green candle. It resisted the northern Bollinger Band, and then this red candle closed sharply down, engulfing or being bigger in size than the green one, basically indicating a strong reversal. And this is exactly what you got over the next few hours. right? And in this case, if you are going to go call, if you're betting against this retracement candle or this engulfing red candle, you're basically betting, you have the odds weighed against you because the price is probably going to retrace. In this case, you lost it slightly. Okay, so there are two reasons why you would not take this extreme call signal. The first is you have a clear bearish engulfing here, right? Indicating that this trend up, which had lasted the previous day, is probably going to reverse. The second reason is also everything that we have discussed in these previous setups is that these candles, when the extreme fired, were not touching resistance levels, and you want to get these as close to resistance levels as possible in order to expire in the money. Notice this candle here is very far away from the nearest resistance. And I'm using a 25 period Bollinger, so I'm just trading a bit more safer. But even if I had a 14 period Bollinger, the moving average would be somewhere around here. And in this case, the prudent thing to do is either not trade for the aforementioned reasons, or you would trade, but you would wait for this candle to actually touch the moving average so that you get a better entry. Okay? So these are the main setups that you want to trade and you don't want to trade. Just to quickly recap, the only setup that you want to trade is where you have, generally speaking, a flat Bollinger channel and a decisive breach of the lower Bollinger or the upper Bollinger and a successful resistance by the previous candle. In this case, it worked. The invalid trade setups is when the previous candle closes well below the nearest resistance level. In this case, you just want to wait till it actually touches the resistance and then enter the end of hour trade, or you simply want to avoid taking the extreme signal. All right? And that's it. You can apply those rules and you'll see immediately that your ITM should improve when trading the extreme signals. As for the suggested time zones, because these are mean reversion signals, the extreme, the curve, the turbo, all these signals on the dashboard, the best times to trade them is actually after 5 p.m. GMT. The reason behind this is, and if you look at the liquidity map, this is the global foreign exchange liquidity map, the markets are relatively thin. 1 a.m. GMT, 11 p.m. GMT onwards, this is the Asian session. Extreme signals that fire there tend to be higher ITM because there's more bounciness in the market. The Bollinger Bands are respected more. Where the sessions become somewhat more riskier and excessively risky is when the news comes out of both the US and Europe in the concurrent EU and US sessions. So we are talking anywhere after 2 p.m. GMT or 1 p.m. GMT, depending on daylight savings time. You can get a lot of news flow that can obviate a lot of these setups for the extreme signals and make them high risk. So we would suggest that you trade this after 5 p.m. when liquidity is lower and the risk of retracement is more higher. And remember, the extreme signals are retracement signals. Okay. Having said this, however, our back test, they are putting the extreme signal at 68.5% over 3 years, and that takes into account extremes that are also fired during these risky sessions. Okay, so the signal is powerful, but if you apply these rules, you can probably beat the signal quite easily and avoid the bad setups. And then if you do trade after 5 p.m. GMT, although it may only be one signal a day, it'll be probably the highest quality setup. Quick overview on money management. So if Xtreme is practiced well with virtual money, and we suggest about 2 weeks that you should try this with virtual money using the dashboard, it is a high percentage win rate strategy, especially if you apply these visual filters, which literally takes a few seconds. And it does not require any brute force tactics like martingaling. We never suggest you to martingale. You can split your trades. So if you feel that the first entry in the Xtreme was poor, you got in, maybe just at the dashboard price or slightly worse, you can wait for the price to move against you by 5 pips or 10 pips. And maybe especially if you can get a better price where it's touching a resistance, then you can enter your second position. Remember, splitting is not martingaling. Splitting is simply splitting your original capital that you were going to allocate to the trade. So if you were going to allocate $50 at one price, we would suggest you allocate $15 at your first price, and if the price moves against you but you still believe in the trade, you allocate $35. In this case, you're increasing your probability of win for the trade sequence, and you're reducing your your overall capital risk. Even if you lose the first split, you could win the second one and make money on the sequence. And worst case scenario, you lose both splits, you've still only lost as much money as you would have had you put the entire amount on your first price. And with that in mind, also, we would suggest no single trade should ever account for more than 2 to 3% of your total account on that particular day. And you shouldn't be suffering drawdowns in binary options, trading signals of more than 5% of your total account balance. We would suggest that you apply a manual stop loss of 2 per day at first, especially. Now, we advocate a rule here at BSB in our education rooms of 5 wins and 2 losses. It's not good to win too much because that gives you a false sense of security and you start to take excessive risks and you overtrade. That's why we would suggest you stick to a 5-win rule. And on the losing side, if you do incur losses, no more than 2. After that, we would suggest you stop trading for at least a few hours. If you are new to binary options, we would suggest you start with a small account size, about $100 to $300, maximum 500, and aim to grow this sustainably over time. If you suffer a total drawdown of more than 50% trading Xtreme, logic says it's probably time for you to stop trading Xtreme and try another strategy, or revert back to virtual money and time your entries better. All right, that's it. I'll take questions now if there are any. Ili, with regards to your question on a recording, yeah, this is going to be recorded and it'll be placed in the dashboard under tips and tricks. Any other questions, anybody? Mark, your question on a recording, yeah, this is going to be recorded and it'll be placed in the dashboard under tips and tricks. Any other questions, anybody? 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 Mark, your question on suggested trading times, essentially 5 p.m. GMT all the way until 8 a.m. GMT the next morning. Because 5 p.m. GMT onwards, you get a almost 40 to 50% drop in liquidity, and that reduces further all the way until 10 or 11 GMT in the night when Asia opens with Australia and Japan leading the way. But the Asian session is also relatively low liquidity, and it's conducive and good for trading mean reversion. So signals like the Xtreme and curve work then as well. It's only after 8 a.m. in the morning that's when the risk sets in. So you have a good sort of 12 to 15 hour window to trade them. Any other questions, anybody? I see a question from Mohammed Hanif. Must we wait until the opening of the next candle to place the trade, or can we place a trade while the candle is still forming? So the Xtreme will typically fire upon the opening of the next candle, Mohammed. And the analysis it conducts is based on the previous candle, which is already closed. And as I've described in this webinar, if the previous candle that closes and the Xtreme signal fires is below a resistance or above a resistance far away from it, then we would suggest you wait to enter until the price hits that resistance, and then you bet in the direction of the signal. Any further questions? All right, I see no further questions. I do see one, sorry. Question from Stefan Bezert. Does the candle body need to touch or breach the lower Bollinger or the upper Bollinger, or is the wick valid touching as well? That's a great question, Stefan. Actually, the wick is valid as well. In fact, the more wick that is exposed after the previous candle has touched a lower or upper Bollinger, the more it tells you that that Bollinger has successfully resisted the price and that this current candle is probably going to move away from that Bollinger. All right. So taken to the max, if the previous candle ends up being a hammer, which is a very strong reversal pattern straight out of Japanese candlestick theory, if it's a hammer on the lower Bollinger, it's likely that for whatever reason, if the current extreme that fired as a call is probably going to expire in the money. So that wick is a good substitute or a surrogate, if you will, for resistance. It's a good way to tell you that, okay, the resistance is holding. And of course, repainting aside, if you take a look at the Bollinger channel, the more flat it is, the more likely you're going to get a lower candle body to wick ratio, exposing these wicks. I hope that helps. Any other questions? I see some people raising their hands. I will unmute you. You can also ask a question typing, but I'll unmute you for now. Yes, Lois, go ahead. Hello? Okay. Does anybody have any questions? Last call for questions. I see a question from Mark Yates. Mark, it fires about 3 times a day. So that's the average you can expect. On a very voluminous day, you probably get about 5 signals. And on a quiet day, maybe 1. The average is about 3. Last call for questions. I see a question from Maria. You can play this webinar on the dashboard. It'll be available for replay because it's recorded, and it is available as a video webinar under the tips and tricks section, Maria. Any remaining questions, anybody? Okay, I don't see any more questions. So I wish you a good trading week ahead and good luck in trading the Xtreme if you choose to do so. Have a great weekend.